Welcome to Chapter 17, where we focus on the important topic of cost allocation, specifically in relation to joint products and byproducts. Here, we'll explore how shared production costs are allocated after a common processing step, which is a crucial aspect in managerial accounting. We'll cover key concepts such as joint products, the split-off point in production, various methods used to allocate costs, and how byproduct accounting differs. Understanding these concepts helps managers make more informed decisions about pricing, profitability, and resource allocation within joint production processes. Let's dive into these topics step by step to build a solid foundation in cost allocation for joint products and byproducts. When we talk about joint products, we're referring to two or more products that come from the same production process happening at the same time. These products share the costs incurred up to what's called the split-off point, the moment when they become separate items. It's important to note that each of these joint products has a significant sales value on its own. They're not just leftover or incidental outputs, each one is a meaningful product in the marketplace. This distinction is crucial when we look at how costs are allocated between joint products and byproducts, which we'll explore further as we go along. Here we see the concept of the split-off point in joint production. It all starts with a raw material input, which feeds into a shared production system. This system processes the input jointly, resulting in common or joint costs. At a certain stage, known as the split-off point, the production process divides, and products first become separately measurable. From this point on, each product, such as product A or product B, can be tracked individually. Product A, for example, can either be sold immediately or undergo additional processing to increase its value. Product B, on the other hand, diverges into its own identifiable output, following a separate path after the split-off. Importantly, all costs incurred before this point are considered joint costs, while costs after the split-off are specific to each product. Understanding this split-off point is crucial because it affects how we allocate costs between joint products and any byproducts. It helps us correctly assign costs and make decisions about processing and pricing downstream products. On this slide, we're looking at the concept of joint products and byproducts, which stem from the same production process but differ in their economic significance. Joint products are the main outputs from a common process and usually have relatively significant sales value. Because they share a production process, their costs need to be allocated jointly. Examples of joint products include gasoline and diesel, or steaks and roasts. Byproducts, on the other hand, are incidental outputs from the process and generally have lower sales value. These are often accounted for separately since their economic impact is less. Examples here include molasses from sugar production or hides from meat processing. Understanding the distinction between joint products and byproducts is crucial for accurate cost allocation and financial analysis, which is what we'll explore further in Chapter 17. Now, let's talk about why it's important to allocate joint costs in production. Even though several products share production costs, we still need to assign these costs to each specific product to understand their true expenses. One key reason is financial reporting. Allocating costs properly helps us assign inventory cost and cost of goods sold accurately. This is essential for accurate financial statements. Another reason is pricing decisions. By estimating the total product cost, including shared costs, we can set prices that reflect the actual cost structure and ensure profitability. Profitability analysis also depends on cost allocation. By comparing the margins of different products that come from the same process, we can identify which products are more profitable and make better business decisions. Additionally, internal accountability is supported through this process, as it enables performance measurement and product-level reporting, helping managers track how well different products are doing. In summary, allocating joint costs is fundamental for reliable financial reports, informed pricing, clear profitability insights, and enhanced internal accountability. Here we're looking at the challenge of allocating joint costs, which arises because multiple products are produced together before the split-off point. Prior to this point, the products share costs, but once they split off, they differ in how much is produced, how useful they are, and their selling prices. This makes it necessary to assign the same joint cost to each product for reporting purposes, even though this allocation is never perfect. Understanding this concept is key because it affects how we value each product and make decisions based on cost information. This chapter dives into the complexities of cost allocation between joint products and byproducts. Here, we're looking at the four main methods used for allocating joint costs in accounting. First, the physical units method allocates costs based on the quantity produced of each product. This means if you have more units of one product, it takes a larger share of the costs. Next is the sales value at split-off method, which uses the market value of the products right at the split-off point where the joint process ends. So the costs are divided according to what the products are worth at that stage. The net realizable value method starts with the final sales value but subtracts any separable costs that occur after the split-off. This approach helps in assigning costs more accurately based on what the products will realistically bring in. Lastly, the constant gross margin method forces a consistent gross margin percentage across all joint products. This means each product contributes equally to profit margins relative to its costs, making it a useful approach for maintaining uniform profitability. Understanding these methods is crucial because the choice of allocation method can significantly impact product costing and profitability analysis in joint production processes. Here we are looking at the joint cost allocation using the physical units approach. The core idea is to allocate joint costs based on the physical output of each product. The formula is quite straightforward. You take the product units, divide them by the total units produced, and then multiply by the total joint cost. For example, if we have 100 gallons in total and the joint cost is $1,000, the per unit allocation is calculated by dividing $1,000 by 100 gallons. This comes to $10 per gallon. So, each product receives a cost allocation purely based on its physical volume, regardless of other factors like market value or profit margins. This method is simple and easy to apply, making it useful when products are similar in nature and volume is a good proxy for cost. However, it's important to remember that it only considers output quantity, not the value or complexity of the products. Now, let's talk about the sales value at split-off method for allocating joint costs. The key formula here is to determine each product's share by dividing its sales value at the split-off point by the total sales value of all products combined. This method connects the allocation of costs directly to the revenue potential of each product, rather than just looking at the output volume. For example, if we have two products, A and B, with sales values at split-off of $80,000 and $40,000 respectively, their shares of the total sales value, $120,000, are 66.7% for product A and 33.3% for product B. If the total joint cost to be allocated is $120,000, product A gets 2/3 of this cost, which is $80,000, and product B gets 1/3, or $40,000. This way, the cost assignment fairly reflects the potential revenue contribution of each product at that point in the production process. When market prices are available at the split-off point, using sales value at split-off for cost allocation is often the best approach. There are three main reasons why this method is preferred. First, it reflects economic causality by linking costs to the product's market values right at the split-off stage. This means the allocation is based on real, observable prices, rather than just physical volume or guesswork. Second, because it is market-based, it more accurately assigns joint costs according to the revenue potential of each product. Higher value outputs are allocated a larger share of the joint costs, which aligns expenses with the benefits those products bring in. Overall, using the sales value at split-off ensures a fair and economically sensible distribution of costs among joint products. Here we are looking at the net realizable value method, or NRV, for allocating joint costs. The formula is straightforward. NRV equals the final sales value of the product minus any further processing costs needed after the split-off point. For example, product A has a final sales value of $150,000. However, it requires additional processing that costs $30,000. So, when we subtract that processing cost, the NRV for product A comes to $120,000. If the total NRV for all products combined is $300,000, then product A's share of the joint costs will be 40%, since its NRV is 40% of the total. This method is particularly useful when the sales value at the split-off point is not directly available because further processing is needed. We start by estimating the final selling price, subtract all costs incurred after split-off, and then allocate joint costs proportionally based on each product's net realizable value. In summary, NRV helps ensure that the joint costs are assigned fairly, reflecting the true value each product will bring after completing any additional processing. Here, we're looking at the method of allocating joint costs using a constant gross margin percentage. We start with the total final sales value, which in this example is $500,000. From that, we subtract the total cost of goods sold, which is $400,000. This gives us a gross margin of $100,000. When we calculate the gross margin percentage, it comes out to 20%. The key idea is that this 20% gross margin rate is then applied consistently across all products. Each product is allocated a share of the joint cost so that it reflects the same 20% gross margin. This approach ensures uniformity and fairness in cost allocation, making it easier to assess profitability across different products that share joint costs. On this slide, we're comparing different methods for allocating joint costs in production. First, we have the physical units method, which is very straightforward and easy to apply. It measures outputs by physical units like weight, volume, or count. The advantage here is its simplicity and objectivity. However, it ignores differences in product value, which can be a major limitation. Next is the sales value at split-off method, which is moderately difficult to use but works well in markets where reliable split-off prices exist. This method links cost to market value directly, which makes the allocation more reflective of economic reality. A downside is that it requires observable selling prices at the split-off point, which aren't always available. Then we have the net realizable value method. This one is also moderately complex and is useful when products are sold only after further processing, or when split-off prices are missing. It estimates the final selling price after processing, minus any additional costs. Because it relies on estimates and assumptions, there's some degree of uncertainty involved. Lastly, the constant gross margin percentage method is the most complex of the group. It aims to provide a consistent view of profitability by equalizing the gross margin percentage across products. This approach is harder to explain and compute but can be very insightful for deeper financial analysis. Each of these methods is defensible, but it's important to recognize that they emphasize different bases for assigning shared costs. The choice of method depends on the specific context and what aspect of cost allocation is most important for your business. When making the decision to sell a product at the split-off point or to process it further, we focus exclusively on incremental revenues and incremental costs. If the additional revenue from processing further is greater than the additional cost incurred, it makes sense to continue processing because it adds value. In other words, when revenue exceeds cost, further processing is beneficial. On the other hand, if the incremental revenue is less than or equal to the incremental cost, the company should sell the product at the split-off point and avoid any extra processing costs. It's important to note that joint costs are not considered in this decision since they are incurred before the split-off. So, the core decision rule here is whether the incremental revenues justify the incremental costs of additional processing. Here, we're looking at why joint costs are considered irrelevant when making sell or process further decisions. Joint costs are those costs that have already been incurred up to the point where products become separately identifiable. Because these costs are sunk, they can't be recovered, they should not influence our decision-making. The key is to focus on incremental costs, which are the additional costs incurred if we decide to process the product further. Since joint costs don't change regardless of which option we choose, the real question is whether the extra revenue gained from further processing is greater than the incremental cost it requires. This helps us determine if it's financially beneficial to continue processing or to sell the product as is. Understanding this concept is crucial for effective cost allocation between joint products and byproducts. When making decisions about joint products, the key principle is to ignore the joint cost incurred before the split-off point because it is a sunk cost and does not affect the decision. Instead, focus only on what changes after that point. Here, the joint cost is $180,000, and at split-off, the product could be sold for $240,000. If we choose to process the product further, there is an additional processing cost of $35,000, but the revenue after further processing increases to $295,000. To determine whether processing further is beneficial, we calculate the incremental gain by subtracting the split-off revenue and the extra processing cost from the revenue after further processing. So, $295,000 minus $240,000 minus $35,000 equals a $20,000 gain. Because the incremental gain is positive, the best decision is to process the product further to increase overall profitability. The most important takeaway is that only the additional revenue and additional processing costs beyond the split-off point matter in this decision. When we talk about accounting for byproducts, one common method is to recognize the byproduct at the point of production. Here's how it works. First, we estimate the revenue we expect to earn from the byproduct and record that amount right when it's produced. Then, we subtract this estimated revenue from the total joint costs before allocating the remaining costs to the main products. For example, if the total joint cost is $100,000 and we recognize byproduct revenue of $8,000, we reduce the joint cost by that $8,000. This means the adjusted joint cost allocated to the main products becomes $92,000. Essentially, the byproduct revenue lowers the overall cost base before we divide the costs among the main products. This approach helps in more accurately reflecting the cost of the main products by factoring in the value generated from the byproducts right at the production stage. Here, we're looking at method 2 for accounting for byproducts. The key idea is that we only record the byproduct when it is actually sold. Instead of reducing the joint production cost by the value of the byproduct, the amount is reported separately as other revenue. This means that the joint cost assigned to the main product stays unchanged throughout. The byproduct sale appears separately in the income statement, which is a simple but important difference from method 1. With method 1, the byproduct's value, say $4,000, reduces the total joint cost up front. But with method 2, we keep the joint costs the same and only recognize that $4,000 as other revenue at the point of sale. The bottom line is that the cash inflow is the same in both methods. The difference lies purely in how the transaction is presented in the financial statements. This approach provides clearer visibility into both the main product costs and the byproduct revenue. When we talk about byproducts and scrap, the key distinction lies in their value and role in production. A byproduct is a secondary product that has a recognizable sales value and is expected to result from the production process. In contrast, scrap is leftover material that usually holds only minor recovery value and is often considered waste. Byproducts are measurable and often worth tracking because they contribute to the overall revenue. Scrap, on the other hand, typically has minimal value and is considered incidental. Regarding their relationship to the main output, byproducts are expected secondary products, whereas scrap is just residual material. Management treats these two differently. Byproducts are planned and sometimes actively marketed, while scrap is not part of any planned product line and is generally managed as waste. From an accounting perspective, byproducts can help reduce joint costs or generate additional income, whereas scrap is usually only recorded when it is sold or disposed of. Understanding this distinction is crucial for effective cost allocation and financial reporting in production environments. Here, we see how a single crude oil input is processed and then split into several different outputs. This is a classic example of joint cost allocation because all these products, gasoline, diesel, heating oil, and jet fuel, come from the same initial crude oil stream. The challenge is to fairly distribute the costs incurred up to the split-off point among these multiple marketable products. This kind of cost allocation is crucial in petroleum refining since each product has different values and uses, yet they all share the initial refining costs. Understanding this process helps in accurately assigning costs and pricing these products competitively in the market. Now, focusing on cost allocation for joint products and byproducts, let's consider the example of meat processing. Here, one animal enters a single processing stream but produces multiple different products at the point of split off. For instance, steaks, roasts, ribs, and ground meat are all joint products that come from the same source and typically have significant sales value. At the same time, other parts like hides, bones, fat, and organs are byproducts, which generally have a lower sales value. Understanding this distinction is important because it helps us allocate costs more accurately between the main products and the secondary byproducts, reflecting their respective economic values. When dealing with joint cost allocation, there are several common pitfalls that can lead to errors. First, using allocated costs for the wrong purpose is a major source of mistakes. For example, when making sell or process decisions after the split-off point, joint costs are considered sunk and should not influence the decision. Second, choosing an arbitrary allocation base simply because it's convenient can distort the profitability of products and mislead managers, so it's important to select a base that reflects the economic reality. Third, ignoring market conditions at the time of the split-off can cause problems, since changing prices can significantly impact the relevance of sales value methods used for allocation. Lastly, confusing joint products with byproducts is a key error to avoid, as the classification affects both how costs are allocated and how financial reporting is handled. Keeping these points in mind helps ensure more accurate and meaningful cost allocation. When allocating joint costs, the starting point is to look at what we can observe at the split-off point, and then choose an allocation method that best matches the characteristics of the products involved. A practical way to begin is to compare the outputs by quantity, which leads us to the physical units method. This method is straightforward and useful especially when quantities are easily measurable. If a market value exists right at the split-off point, the preferred approach is to use the sales value at split-off. This directly connects costs to the actual market prices at that stage, providing a realistic allocation. However, sometimes products need further processing before we can determine a selling price. In those cases, the net realizable value method is the appropriate choice, since it estimates the final value after additional processing costs. Finally, if there's a requirement to maintain a consistent gross margin percentage across products, we use the constant gross margin percentage method. This approach ensures fairness by keeping profitability proportional among all outputs. Ultimately, the key is to choose the allocation method that best fits the economic circumstances of the products you are dealing with, ensuring the cost allocation is both logical and relevant for decision-making. Here, we're focusing on joint products, which are multiple products that arise from the same production process until a certain point known as the split-off point. At this stage, the products become distinct. Companies need to allocate joint costs to properly value inventory, report financial results, and analyze profitability. There are four main methods used to allocate these costs: physical units, sales value at split-off, net realizable value, and constant gross margin. Among these, the sales value at split-off method is often preferred because it uses actual market prices available at the split-off point, providing a more accurate allocation. It's important to remember that when deciding whether to sell a product as is or process it further, joint costs are not relevant. Instead, only the additional revenue and costs incurred after the split-off should influence that decision. This helps firms make better choices about maximizing profits. Overall, understanding these concepts ensures more precise cost allocation and sound decision-making in managing joint and byproducts. To wrap up Chapter 17, let's focus on the essential points you need for reporting and decision-making. Joint products are created together up to the split-off point, meaning there's a single process with multiple outputs. When it comes to assigning costs, allocation is primarily for reporting purposes, helping us value inventory and measure income accurately. The choice of allocation method, whether based on physical units, sales value, net realizable value, or gross margin, depends on the specific situation. It's important to remember that joint costs shouldn't be considered in decisions about further processing. These sell or process decisions should be based on analyzing incremental revenue and incremental costs. Understanding how to allocate costs correctly between joint products and byproducts ensures clearer financial insight and better business decisions.